Peters Financial is a registered investment advisor. Statements and opinions expressed are based upon information considered to be reasonably reliable, but should not be relied on without additional information that is particular to your objectives and suitability. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and is not intended to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you.
Welcome to Accountable, where your business is our business. Hosted by David R. Peters.
Hi, everyone. Welcome to Accountable, the podcast where your business is our business. My name's Dave. Thank you so much for being here. Hey, if you have been paying attention at all, I think, over the last few months, the world of tax has really been in a state of flux. I don't know that I can remember a time, at least back to the TCJA, where we have seen more of mainstream media attention on tax. It doesn't happen a lot, but it does happen. And so certainly that has been the case here with the One Big Beautiful Bill Act that was signed into law on July 4th, 2025. And so today we have a great guest that is going to help us talk through a lot of the provisions that are going on in this bill and just tell us as practitioners what we should be expecting as we're entering into planning season, as we're getting ready to talk about these things with our clients. I think that that this is just a topic that is on everyone's mind. So my guest on Accountable today is Bill Harden. Bill is an associate professor in accounting and finance at the University of North Carolina at Greensboro. He is also someone who I've had the pleasure of team teaching with for several years. He teaches and speaks all over the country and is certainly someone who is a great person to be talking about such a big topic like this. So, Bill, welcome to Accountable.
Thanks, Dave. It's great to be with you again. Like you said, yeah, we've been teaching together now for a long time, so it's good to get back in touch base. I don't think you and I have had a chance. Maybe it was your podcast a little over a year ago, I guess, was the last time we did this, though, right when we had a chance to sort of sit down and talk online like this.
Yeah, and I have to tell you, my friend, this has been just a very, I think, tumultuous. I don't even know if that's the right word, but it's just been a year of change, I think, for a lot of practitioners, where we have this gigantic piece of legislation that went through. I guess the good news is that it went through in July and not January. So maybe that's a win.
Yeah, it's funny you mentioned that. That's we were sitting here, and they had talked about wanting to get it out, March or April by Memorial Day. And I'll be honest with you, when they missed that deadline, I was thinking, okay, we're going to be here in December again, trying to scramble. And then when it actually came through in July, I mean, it's not you've been in practice long enough to remember when they've actually done retro things from early in the next year and go back. And that is very unpleasant to have to deal with because you can't go back and undo transactions from the prior years. So, in that sense, yeah, it's really good that they got this done early. Now, me, I'm going to be nonpartisan. It's part of my deal with the university. So I have to be that way. And so I'm not really going to say whether it's good or bad. I'm just simply saying that if they were going to do it, I agree with you. It's great they got it done mid-year instead of waiting until January to do it and then making it retro.
Yeah, well, and I think that that's true. And I think, regardless of kind of what side of the aisle that you're on, I mean, I think we as practitioners, we kind of cheered a little bit at the fact that we were dealing with this over the summertime as opposed to, kind of right at the first part of the year. Because like you said, that's really tough because you really can't do any tax planning when something kind of comes through in January. We would
Yeah.
be remiss though if we didn't mention kind of the other piece of this is the fact that we're probably not done yet.
Oh yeah, absolutely. There's going to have to be a lot of guidance provided with respect to a number of these provisions. They're too new. Although I'm hoping that they will sort of not reinvent the wheel on everything. If you don't mind me jumping to a topic, I was one of the ones that I think is actually very interesting is the one for production property,
Yes.
because that's one, where you now got the potential for things that would normally be 1250 property going over 39 years to get those things under bonus depreciation. But when you read the law on that, a lot of the terms that they've picked, with respect to production and with respect to like the resources and things, it looks a lot like you've been around long enough to remember the old production activities deduction
Yep.
that we had 20 years ago. And I should say expecting, I'm hoping they will simply revive a lot of that language so that we don't have to reinvent the wheel on everything. We can just kind of pull what's already there. But we'll see.
Yeah,
We'll see.
and I think what you mentioned there is a very big deduction. So for
Oh, yeah.
those of you that maybe don't know as much about this, so this is a deduction for qualified production property. It's going to fall under 168. I believe the code section is 168N, if I remember
Yeah,
right.
I think so. I think it's subsection N. Yeah.
But anyway, it's an immediate deduction. What is interesting is it looks like what they want you to do is they want you to separate out the things that aren't related to the production process. Those aren't eligible for immediate depreciation, but the parts that are involved in the production process, those are available for immediate, bonus depreciation, basically 100% deduction straight off the top.
Yeah, I would agree. That's kind of my take is that, what we've got is well, things that weren't production but would have otherwise met the 100% bonus could still do it. But yeah, I think
Right.
now we're really going to be dealing with two buckets. One of them for production, and which now is going to include other things. Like
Yeah.
I said, that would normally not have gotten, because the old, bonus depreciation, the normal rules are 20-year life or less. And so getting, this ability to take even longer things fast. I think the catch there people have to watch out for is recapture,
Bingo.
especially in the first 10 years, they're going to have to watch out for recapture. Um, but even after that, there are differences in 1245 and 1250 recapture that people need to, professionals need to watch out for and things like that. But
Yeah, for sure.
the
Yeah.
12,
Go
I'm
ahead.
sorry, go ahead. Go ahead.
I was just going to say, yeah, I mean, I think that you hit the nail on the head because that 1245 recapture is a much bigger deal. We don't get nearly the benefits that you see sometimes on 1250 with the unrecaptured, 25% gain stuff. That's not a thing with 1245. And so, 1245, presumably it's going to be a full recapture rule on this. And so that could I think bite people. They're going to love the big deduction, kind of in the first year, but that's but if they recapture, especially like you said, within the first 10 years, that could be a negative tax surprise, as a friend of mine used to say.
Yeah, yeah. If you don't mind, let's just review for everybody out there a little bit, about this difference. I mean, prior to OB3, really the only time we saw bonus depreciation typically on real property was if it was something that then qualified for the 15-year life as an improvement.
Right.
And then because that 15-year life, the Jobs Act had made that where you could bonus depreciate those, but that still stayed 1250 property. And so if you held it long enough, because remember, 1250 is just ordinary income to the extent that you have accelerated depreciation that you took faster than straight line. So if you think about 15-year property, if you've held it 15 years, there is no accelerated greater than straight line,
Right.
and it's all just going to be then unrecaptured 1250, which is just a higher capital gain rate. But yeah, but on 1245, the whole recapture amount is ordinary income. And so, yeah, and that's something we've always watched with 179, because when we take section 179 on things, it creates that 1245, that full recapture. People are gonna have to watch that on this production property as well.
I think you make a great point. Especially too, I think it's important right now because we do see the increases in 179 as well, up to
Mhm.
a $2.5 million deduction at this point. But we should remember that depreciation is not depreciation is not depreciation. How you actually
Mhm.
depreciate things still
Yeah,
matters, and the code section that you choose to use still matters as well. So those
yes,
distinctions between bonus and 179 are still very important, I think.
yeah, yeah, yeah.
So would you say that that is maybe one of the more impactful changes that we have seen as a part of OB3? I mean, are there other ones that you would say are, probably have the greatest impact?
That's the one that really jumped out at me as just a big striking change. And I guess it shouldn't have surprised me that much, given that the administration has been trying to get this large, they've been trying to get a large inflow of investment into the US. And obviously, giving a tax advantage for building things here is sort of designed to encourage that. Again, we'll
Absolutely.
see how effective it is, but it's clearly designed to do that. So, it's funny when I first saw that come out, I was very surprised, but then, in retrospect, I'll say I shouldn't have been. You know, yeah.
Yeah, yeah. No, I think that's true. I think that's a great point. Were there any other ones that I mean that really that you felt made like this huge impact? There's ones that have gotten a lot of attention. The tip deduction, the overtime deduction, but I'm not sure
Mhm.
that those necessarily have the impact that maybe some of the other things that are out there really did. Would you agree with that, or am I maybe looking at it too closely?
No, no, I would agree with you. I mean, because when you look at the tip deduction and the overtime deduction, they're fairly limited. I mean, you're not going to see more than $25,000 really of income effect on anybody from either of those. Uh, so I mean, so I think they're. I mean, I think this is one of those times where you saw things discussed in the political world, and it was felt that those needed to happen so that basically you could keep the promises that you made.
Right.
But the dollar impact of those, I'm not sure is going to be is going to be that large, even though it's not, doesn't jump out at you as kind of a critical thing. Just the simple fact that so many of those things that were going to be eliminated in in 2025, just the fact that they've been made permanent. Again, it doesn't mean that we're not going to have changes because things are only permanent until they decide to change the login.
Sure.
But at least it's very likely we have stability for about the next 3.5 years,
Right.
probably even a year after that before things could really be could really be played around with. So in that sense, we've got some good some good timing benefit for clients being able to help them figure out what they're going to do, because we would not anticipate a dramatic change in the next, let's say, the next 3.5 to 4.5 years. um, and so that's to me is a nice piece of the legislation. Having said that, though, one of the things that did surprise me quite a bit was the very abrupt end to some of these energy um, provisions.
Yeah, and let's touch on that here because I think you
Yeah.
you you make a great point. Some of these energy provisions they gave a very short runway in terms of when they were going to end. For example,
Yes.
the clean vehicle credits, both the used one as well as the new one, both the commercial version as well as the non-commercial version.
Hmm.
All of those set to end September 30th. There were some that were extended out until the end of the year, and a couple of other ones that were extended beyond that. But for the most part, it was a pretty quick cutoff. And I think if you had clients that were kind of depending on that, that could really be, again, kind of a negative tax surprise there, maybe at the end of the year to maybe folks that just really don't know some of those nuances.
Yeah, and it's funny to me, not just I guess the vehicle ones going away didn't actually quite surprise me as much as the two. I want to get the exact title right here, so that's why you see me looking. It's um, the the home energy ones,
Yeah.
the energy efficient home improvement credit and that residential clean energy credit. Those were the two that You remember there was that one. Do you remember the old $500 lifetime? I think it was that we
Yes.
had on the
Yes.
one, and then
Yeah.
we finally get it where now they're going to say, "Hey, $1,200. It's each year, and you can have people gradually make improvements." I was actually surprised to see that one just kind of basically be, "Hey, we're going to get rid of that very quickly."
Yeah.
It's.
Yeah.
I thought it might go longer because that's been a very popular provision really for about 20 years. It's just it has such a small cap on it before that nobody could really use it. So
Yeah, and I think that that's a great point. And so you were referring to the $500 used to be a one-time
yeah, one time. Yeah.
credit, and so
Mhm.
you would have this conversation with clients, and they would say, "Hey, I got these energy efficient windows," and you're like, "Great,
Yeah.
$500," and they would say, "Well, what if I do it again next year?" And you're like, "Well, that's a
Right.
zero," and
Mhm.
and and
Yeah.
finally you got to tell them some good news here within the last couple of years with the Inflation Reduction Act, and you say, "You know
Yeah.
what, hey, it's $1,200 per year," and everybody was really excited, and now that's been being pulled away.
Yeah.
Makes tax
Yeah.
planning kind of interesting there, I think, especially for folks that have chosen to invest in some of these green energy initiatives.
Yeah. Yeah. And I think that area, you and I had talked a little bit before the broadcast today about the idea that, professionals are really trying to figure out what they're going to do about this stuff for planning. And those energy efficient ones are the ones where you really have to be thinking fast. I mean, if I was a
Yeah.
professional, the ones that I would really be looking at like now as opposed to November are those because clients are going to have to decide whether or not to do these things or not very quickly,
Yeah.
in a tighter time window. And then there are other things, that we can kind of plan out more toward the end of the year if we need to. But for clients who want to think about energy stuff that's going to phase out before this year's over, they need to think about that.
I think you're right. I also think that it is interesting too that some of these provisions that we've already talked about, some of these things with energy credits, as well as some of the things having to do with the increased depreciation deductions and things like that. A lot of them are based off of acquisition, not placed into service dates, which
That's
is
true. Yeah.
something that is very. I think we as accountants, I think we think in terms of placed into service. I mean, that's
Right.
just kind of how we think. And some of these things we should point out that, like, acquisition date is important. We talked about bonus depreciation, at least as it pertained to production property. The 100% bonus is based off of acquisition, and so theoretically, then I could have bought something that would qualify for bonus depreciation on January 10th, but yet not place it into service until after inauguration day, after January 20th. And it actually would be under the old system. It'd still be that 40% bonus depreciation rather than 100, because you have to acquire it after from January 20th, 2025 and forward in order to actually get that 100% bonus. Same thing with a lot of the energy credits too. It's based off of acquisition date, which I think is an important point, I think, for practitioners.
Yeah, I think a lot of these energy credits, like the residential ones I was just mentioning, I think they use the term expenditure in the
Right.
law. It's like
Yeah.
when did you have the expenditure? Yes, and
Yeah.
you're right. That's different than necessarily placing it in service, and so
Yeah.
it can, so professionals need to really pay attention. I know, I drill with my students, go back and look at the code. Always start your tax research with the code. Go
Yeah.
back and look at what the law, actually says, because sometimes people paraphrase. They'll mix or miss a word, and an expenditure is a very different word than, as you said, placing in service. And
Right.
so,
Right.
yeah, it's yeah.
Yeah. I think that those are all great points. You mentioned some of the things that you thought were a surprise. Was there anything else that you looked at and you're like, man, I thought we were going a different way than where we ended up. We did see a lot of extenders. I think that is fair to say. So maybe on some level, maybe the surprise is how many things just got extended and maybe how many things didn't change from the TCJA. I don't know. What would you say? Were there anything that anything that stood out to you?
Well, it really isn't a surprise. I was sort of, curious where they would end up with respect to the state tax deduction.
Yeah.
And that's one where it looks like they sort of compromised. And then, sort of push the problem down down the field. I think I was surprised about a few of the things that are only coming in again for 3 or 4 years,
Hmm.
like was it the like the Trump savings, the Trump account
Yes. Trump
for
accounts. Yep.
the kids. I guess maybe because their budget numbers, that just didn't feel they could take it longer than that. But I was sort of surprised to see another round of things that 3 or 4 years as opposed to a longer period of time.
Those Trump accounts I think are interesting. So for those that maybe haven't heard that term before, this is a tax deferred savings account for minors. That's probably the simplest way to describe
Yeah.
it. And what is interesting about them is that they are going to be a tax deferred way to save. If you use them for certain purposes, you get a preferential tax rate on the distribution. You get a capital gains rate rather than the ordinary income rate. Um, the accounts themselves can be used for different purposes. So, whereas a 529 plan, which is where a lot of the comparisons have seemingly been to these Trump accounts for a good reason, you can use a Trump account for education stuff, but you don't have to, which is the interesting thing I think about these bills is that you don't have to use them for education. So it's a little bit different than like a 529 plan where you're kind of restricted to just higher education.
Exactly. Yeah. These accounts, like I said, to me, when I read the rules, it seems like it really is just sort of a saving slash investment, sort of in mainstream investment types of things that the kids can have. And then it's when they they're just getting all that tax deferred sort of growth in them because you're not getting taxed
Yeah,
on your investment income year to year. So clearly that would be helpful compared to, say, for example, having things that might be subject to the kitty tax.
right.
So again, I thought these were interesting. You talk about the treatment coming out at the end. I'm kind of curious to see what they're gonna do with that, because it looks like to me what they did is they just took the regular sort of IRA rules and then dumped this kind of savings account
Yes,
on top of it. And
correct.
so, when I've been talking to people about this, I've been saying, we're probably going to have an ordinary income effect at the end when we take this stuff out. Just again, simply because of the fact that, again, they just put it on top of those IRA rules. And I think we're going to have to watch and make sure, how clients deal with this at the end to see how it's going to be taxed. But for me, the big benefit is that this deferral of on the income, along the way. The other thing that really is interesting is there is I think it's called a pilot program. Yeah, I was checking my language. The pilot program,
Correct.
it's funny where for these kids born between 25 and 28 inclusively, they actually can have basically $1,000 that just is put into that account
Yeah.
basically by having the tax form done right. And so, that to me is a really interesting kind of an idea. Again, I'm not as a policy matter, I'm kind of like, I'm not sure how good this is, but
Yeah.
it's an interesting one because it's something we haven't really seen before.
Yeah, and so what you're referring to, Bill, is you're referring to the pilot program that essentially, if somebody does not have a Trump account and the person is born from 2025 to 2028,
Yeah.
the government can essentially set up an account for somebody and actually fund it with $1,000.
Right.
And so it's an interesting concept. It's an interesting idea. I think it's interesting to see how these Trump accounts are really going to be used. One thing that I
Yeah.
think that we should mention though is right now no one can actually fund a Trump account
Correct.
because
Correct.
that's not going to
Next
be for
year.
another year. So July 4th, 2026 is the earliest. So if you're sitting there thinking to yourself, why hasn't my financial advisor said anything to me about it? Well, it's because you can't do anything about it yet. But eventually
Exactly.
it's going to come into play for the planning.
Exactly. And they're gonna need that year. It's good they did that in the sense that they need it to get out the guidance, because just like you and I have been talking about, there are some
Yeah.
unclear things to us in these rules. We need the IRS to give us guidance. And of course, they're going to have to put out guidance to the brokerage houses and the financial institutions where we're going to maintain these accounts. for them to know what's going on. So yeah, so luckily they didn't make this one instantaneous because um, that would have been very difficult to deal with. I know some people in practice get real irritated when you talk about the healthcare legislation from 2010. And again, I'm not going to get on about whether we like or don't like the policy of it, but the one thing they did well with that was a lot of the stuff had dates 2 or 3 years out, so the IRS could get us guidance before it
Yeah.
took effect. And this
Yeah.
is one of those where I was glad to see them do that so they have time to make adjustments for it.
I think that's very well said. One of the things that I think that we need to remind folks is that just because you have laws, that doesn't necessarily mean that you
Mhm.
know every piece of it. And so, so I think that that's an
Yeah.
important point here, especially right now. I know that we're getting, probably if you're a practitioner right now, you're getting a lot of client questions because it's
Yeah.
in the news. It's on people's minds. Like I said, I am being very serious and saying that I can't remember a time, at least for a while, that we've had so much attention on tax news right
Yeah.
now. And so it's on clients' minds. But remember though that it takes a little while. I mean, the normal flow of things is that we get a bill passed and then slowly over time, usually over a period of years, we start to get the
Mhm.
guidance.
Yeah.
And we have not seen a ton of guidance as you and I sit here and record this
Mhm.
conversation. We haven't seen a ton of guidance from the IRS. We've seen a few things, but we haven't seen a ton of guidance really getting into some of the details of some of these deductions and some of these credits and some of these new things.
Exactly. Yeah. And for the stuff that hasn't changed, that they just extended, that's fine, And even for things like the qualifying business income deduction, because really with that one, they made it permanent. But the only thing that really changed is like, for example, instead of having phase out windows of 50,000 and 100,000, we now have phase out windows of 75 and 150,000. So, the regulations that are already out there, okay, this is easy to deal with. I just have to change the
Sure.
denominator in my math
Sure. Yeah.
and that's
Yeah.
easy for the software programmers to deal with who do our tax packages
Yep.
because again it's just you're not really changing. I mean, yeah, they added that minimum deduction in there, but for QBI, but overall that's not going to be a hard thing to deal with. But some of the new ones will. I'm sorry, I'm switching subjects on you because I just was looking at my review thing and it made me remember. I know I've been a long time dealing with taxes because we've now come full circle on the auto loan interest deduction. See, I can remember learning taxes when we
Yeah.
used to get that before the 1986 Tax Act, because I'm
Yeah.
that old. And
Yeah.
now, now they bring that one back. I guess that's one that actually did kind of surprise me a little bit because I hadn't even thought about that, because we didn't have it, since 1986, and then now they cap it. What is it, $10,000, I think, but
Yeah.
you know.
It is an
So,
interesting that one in particular. I think is interesting too, simply because while a lot was made of that, one of the things the practitioners have to watch is that one begins to phase out actually pretty at a pretty low AGI level, and so that one is actually a little bit lower than what you see with the tip deduction and the overtime deduction. It's actually a little bit lower. It starts to phase out a little bit sooner. Now that being said, just kind of practically speaking, $10,000 of interest on an auto loan in a year is kind of a lot. So, so I think that the number of people that you see kind of going up over that, you're probably not going to see that a lot. And maybe a little bit, even if you're in the phase out, probably still okay. But,
yeah.
is kind of interesting that they chose to phase that one out a little bit faster than maybe some of these other things.
Yeah, yeah, I agree. And there are a number of provisions, as you know, in here that do cut based on, the income level. The tip one does that. The overtime one does that. I'm not really sure. Like I said, the people who would be earning overtime, I'm not sure they'll ever actually get into that,
Right.
point of having it, phased out. You'd expect most people at that high income level to be exempt. That type of thing. But again, it's just it's interesting to see the way they did that. Yeah.
So let's talk a little bit about that wage, that overtime deduction and that tip deduction, because we did mention it, but we didn't really kind of dive into this here. I personally think that this is two interesting points now. So one thing to be clear on, I've gotten this question a lot from a lot of practitioners. I think that when you hear no taxes on tips, when you hear things like no taxes on overtime, people assume that that is an exclusion. It is not. It is a deduction. And it is, and more specifically, it's supposed to be a deduction that is based off of what is reported. So for example, if I don't actually report a tip that I got, I would not be eligible for a deduction.
Right. That's an incredibly important point. And
Yep.
the law does talk about the fact that, where tips aren't reported through the employer, they talk about the importance of self-reporting
Right.
those tips on the correct form in order to get that to go into the system. So there's an interesting thing here, right? We're getting the tips. You're going to get basically they're going to have to come into income,
Mhm.
and then you're going to try and get a deduction. But by them coming into income, remember there's going to be an employment tax piece to
Bingo.
this, and
Yep.
so it's like I'm kind of curious just in terms of the behavioral aspect again. And I'm not saying that I'm not saying that anybody doesn't report the correct amount of tips. Okay, I'm not going to say that, but we believe that the service, at least I think, believes that tips tend to be underreported, and it's why they sort of work so hard on it. But this will be an interesting one because now you can come into more compliance to get out of regular tax. In order to do that, you're going to incur the employment tax. And I think it'd be just an interesting sort of behavioral experiment to see if now people will be more likely to more fully report because they get that deduction, even though it does mean, there's kind of a trade-off, less income tax, more employment tax.
Well, as somebody who at least partly paid for his graduate school at the University of Illinois by delivering sandwiches, I can
Yeah.
tell you that that tip income is pretty important. Was pretty important to me as a college kid.
Yeah.
Yeah. I mean, look, hey, I think that there certainly I did have colleagues that didn't report tips and that kind of stuff, and I knew better. I knew what I was
Yeah.
supposed to do, and so I was always reporting mine. But I do think it brings up an interesting point. The reporting itself really doesn't get easier for the employer. We should point that
Correct.
out as well. Is that they're really not getting out of anything through these things. The deduction is based off of what is reported, not necessarily what is what they may have received. If they didn't go into
Yeah.
income like you said, there's no deduction available. um, the other thing that I think is important to realize too is, at least with the tip deduction, I had a practitioner the other day, Bill, who was in one of my seminars. He said, he said, could I put out a tip jar on my desk, as people are walking out, because they were just so thrilled at the way that he had done his their tax return. They were so thrilled about that they would want to leave that tip on the way out the door, in addition to paying for the fee for the return, of course. That they would be able to leave that tip. He said, am I going to be able to take a tip deduction for that? And
Yeah.
the answer to that question is no.
No.
So those of you that are
No.
practitioners, okay, don't start bringing out the tip jars. Okay, it won't help you out, at
Right.
least not here. Although I don't know if you can get somebody to tip you for your tax return, maybe that's worth it. I don't know, but
Yeah.
but that won't get you a deduction here.
That's correct. Yeah, because they limit it in the law, as I recall, to professions that were traditionally subject to getting tips before this law passed. And then they're giving us clarification on that. You and I were talking about before again about seeing some things they put out here in the last few days, but none of the things are surprising. It's what you would
Right,
expect. It's like the people who are in food service, or like people who do cleaning services, or people who are like home repair, those
right,
types of things. I didn't see anything in the list that surprised me as somebody that, yeah, these are the people that we would normally, tend to tip. And they're not going to let us get into some game where we say, oh, I'm now getting tips instead of my salary, or getting tips
right.
instead of my regular wages. They're not going to go for that. Yeah.
Yeah, and I think that that's an important point. And look, I know that especially over the last couple of years, we've heard a lot more, at least in mainstream media, about tipping culture and what's appropriate to tip for and what is not. I know that that people have been examining this idea. It is important to realize that according to OB3, that the IRS is going to come out with a list
Yeah.
of professions that are eligible for the tip deduction. So it's not
Right.
like we shouldn't have to do too much guessing in terms of what exactly is eligible for this.
Yes.
So again, I think that you're right. They're going to lean towards the things that historically we have always thought of as being professions where you would customarily tip. So I think
Correct.
that that's an important point to make here as well. I believe that they are supposed to publish that list by October 2nd, I believe is the date that they actually put in
Yeah, I
OB3.
apologize. I don't remember the date, but that sounds right. I don't remember
Yeah.
the exact date.
Yeah.
But
So that one's coming up here too. So anyway, you should get some clarity at least from that before tax season. Um
yeah.
I'd like to bring one up here just to get your opinion.
Sure.
You and I have worked together and been friends here for a while. I one of the ones that I personally was a little bit surprised at was just the extender on the mortgage interest.
Mm,
Home prices have gotten to the point where people are taking out bigger mortgages. Interest rates have been higher over the last few years. This is not anything new. I was
yeah.
surprised that we stuck with the interest off of the first $750,000 of acquisition indebtedness, as opposed to what would have happened if we would have just let this expire. We would have gone back to pre-TCJA, and that would have actually bumped it up to 1 million.
Yeah, to a
Um,
million. Well, yeah, and if they had not kept the equity piece where that
yeah,
was eliminated, you really could have gotten it to 1.1 million. So,
yes, yeah,
yeah, part of me wonders if that was more a matter of them wanting it to appear that it's not strictly helping higher levels of income, that it's helping and there are a number of pieces that clearly are geared toward the lower income, like the tip one and the overtime one and things like that. And I wonder if maybe that's why they did that, or it could just be that again they didn't want to make their budget numbers worse, and so they left it at at the 750. But that yeah, I do know what you mean because well because I'm here in North Carolina in the Greensboro High Point area where it's not really a high cost of housing.
right,
And so I mean I'm sure you could buy houses that are more than that, but most of us don't do that here. But my wife's company is based in the DC metro, and
yep,
there, you're going to pay $1 million for a normal family sized house.
right.
And so yeah, it is kind of interesting in terms of the limitation on that. Uh, I don't know. The cynical part of me would tell you it's because the government has so much debt now that they don't want anybody else out there borrowing besides them because they don't want to do the cost of
Yeah,
borrowing any
right,
higher.
right.
But
Yeah,
again, that's
sure.
me being cynical. I don't know that that's really the case or not. So
I just found that one to be a bit interesting personally. A couple of the things that I did kind of before the bill was finalized was I kind of speculated a little bit, and I kind of said, I said if they were going to let one go and let one expire, that might be the
yeah,
one. So it didn't come out that way. We're still at $750,000 interest off of the first $750,000 of acquisition indebtedness. No real changes to the definition of acquisition indebtedness either, which is also kind
right.
of interesting itself. So interesting to see that one. Um, I think what you do see though, and what may be something that a lot of practitioners may want to think about, at least on the individual side, if you're doing individual financial planning, individual tax planning, is I do think you'll probably see more people itemize this year as a result of some of these changes because you do see the increase in the salt cap, okay, up to 40,000 bucks.
I think that's going to be the big one that causes some people to come back into the itemizing world who would otherwise have been out of it. I think that's going to be the big one in that field. Yeah.
And I'm not sure how much planning you can really do around that. Maybe it becomes, you go back to kind of the old school rule where you always have people pay their state income taxes, by December 31st so
Yeah.
that you can shove that Q4 estimate into the deduction on the federal return.
Correct.
Maybe
Yeah.
that kind of comes into play a little bit more, but we should mention too, the salt deduction does have a phase out too. So so that's the other piece of this too. But in general, it's going to be at least a little bit higher, and presumably that might kick a few people up over to make them itemize one more time. I think that that's worth maybe
Yeah.
noting here.
Yeah, that's true. And of course, we've had really even since the Jobs Act, on the charitable contribution side, we've had people who will like, stack their charitable contributions into alternating years to come into itemizing or not. Some other people have also used some account mechanisms to
Mhm.
deal with charitable contributions, right? To take the one big deduction in one year and then have that account pay out over the the following years. So yeah, this is definitely one that I think people want to think about a lot, or professionals want to think about a lot. When we get into late November, early December, start running some calculations and see where those tax payments need to go, whether it does need to be December versus January in terms of where you think you'll get the biggest effect. Yeah.
You mentioned charitable, which I think is another one that I do think is presents some interesting challenges here. Your charitable contribution deductions actually now have a floor associated with them. It's 0.5% of the
Yeah.
contribution base. For charitable contributions on the corporate side, it's actually a 1% of taxable income floor. So that presents some interesting challenges there as well. I know that certainly we did get at least on the individual side, we did get that deduction for non-itemizers. But that one's a little bit more restricted now than it has been in the past. No donor advised funds is the big one I think that you were mentioning there.
Yep.
And so but with itemized deductions, that could create some trickiness because, let's face it, what is the deduction on Schedule A that people can do the most with? It's
Yeah.
probably charitable. I mean, people don't really, you can't really sort of
Normally it is.
create
Yes.
mortgage interest.
Yeah.
You can't really create more state income taxes.
Correct.
So, but on the charitable side, you can certainly do that.
Yeah.
But with that floor, that creates some trickiness now that we just are not used to, I think.
Yeah, that will be something definitely that we have to think about. Also, you're not going to probably want to stack everything, given that you have what is it, the $1,000 and maybe a couple $2,000 that they can do, even if they don't itemize in a given year. So now you would still want probably some charitable contributions, right, in those other years when you're not, yeah, when you're not stacking them. But yeah, that's one I had not thought about at all, was that they would put a floor on those, on those things. I had not anticipated that one coming. So
And I know at least for some of my colleagues who work in the nonprofit realm, I know that that is of particular concern. I think and I think rightly so. I mean, they
yeah,
are they're concerned about those smaller gifts, where it's like hey, I gave $50 to this, $100 to that. To your point, I mean,
yeah,
it's going to take you a little bit to kind of get up over that floor, and so if people aren't giving and getting a tax deduction out of it, does that dissuade giving? I think that that's really the question to be answered. I guess maybe the cynic in me, Bill, would say that it's never worth it to give to charity just for the tax deduction,
yeah,
but at the same time, though, I do know that people, clients, think about it that way sometimes.
yeah, yeah. I agree. That's one thing that, yeah, clients, got to work with them on, is understand you don't want to, you don't want to spend $1 to save 30 cents, because then you're
Right,
still out to 70. It
right,
needs to be something you want to do. I was just double checking. There, you see me look away. I was just double checking myself on the dates. Yeah, that floor and the 4 AGI deduction for the 1,000, that those are both 2026 changes.
correct.
So we
Yeah, I
won't
should have
see
mentioned
those
that.
on the
Yep.
2025 turn, the 2025 return, but we'll see those on 2026. And yeah, if I apologize, you'll see me occasionally checking, because my memory is so bad now. I used to be able to memorize this stuff, and I never worried about it. Now it's like they keep changing things, so I tend to say, well, let me double check that date, just to make
Well,
sure
yeah, Bill,
I
you and me
remember.
both, buddy. I think, so yeah, so it is important to point out that the charitable one doesn't take place until 26. The increase in the salt deduction is 25. Also, with the tip deduction, that one is also 25. Same thing
Yeah.
with the overtime deduction, that one is also 25.
Yeah.
One of the things that we should also mention too, because of both of those, because this bill was passed in July, halfway through 2025, employers are allowed to use any reasonable method of allocating tips and overtime pay for that
Yes.
early part of the year when they didn't know they were supposed to be tracking such things if they weren't doing it.
That's a great point. Yeah. Yeah.
So some of these things it is important to pay attention to dates. But yeah, the charitable floor doesn't take place until 26. But some of these other things that we've been talking about are 25. The auto loan interest deduction is also 25 as well. And so there's a lot of pieces, some pretty significant planning points, I would say, both on the individual side and I think on the business side too. I mean, for a lot of these deductions and credits.
Yeah, and as I recall, I think they are going to, coming up, change the withholding tables a bit to deal with the tip and the overtime piece. I'm not quite sure how they're going to do that, but I remember seeing something that the IRS was directed to do that. And so the way I mentioned it is people need to think about if you're expecting a certain amount to be withheld for the year, you may want to double check and make sure your monthly is still having that amount withheld and coming out, because it may be that the tables adjust a bit.
Yeah, and so we should be clear there too. So the actual forms themselves for 25 are not going to change. They've already said that, but
Mhm.
for 2026, we're already seeing draft forms of the new W-2s and things like that to so that people are kind of knowing what is expecting.
Yeah.
The IRS did want to give us at least a little bit of a runway for this year, where they essentially said that nothing's changed. Where I think it's going to be kind of interesting, though, is that again, I think you do have if you do have a client that does have tips, again, the way that that law reads is it's supposed to be on reported tips,
Yeah.
and so if the form doesn't change in 25, but we have tips, and we can also use any reasonable method for the early, for the early part of the year for 2025. Um, we may get into a little bit of messiness, I would say, in trying to figure out whether or not our client is actually conforming to the rules and whether or not we're entitled to a deduction or not.
Yeah, and it may be that the client wants to self-report the tips and deal with the employment taxes. That's something I'm hoping we'll get a little more guidance on before the end of the year. But yeah, that's one of those pieces that will be interesting to see how to deal with.
Yeah, yeah. So
Yeah.
lots of interesting things going on here in tax land right now. Bill, what would you say is maybe something, if you could give some advice to some of the practitioners out there that may be listening to this? What would you say is maybe some things to keep in mind as they're entering into planning season, as we're talking about even more changes coming up? Any words of wisdom?
Well, this isn't so much a tax piece. Just you and I both come from both the tax and financial planning side.
Yeah,
And you know, I was listening to a financial planning podcast the other day, and it actually reminded me again that this idea that I think sometimes we start focusing on all these trees, like this tax piece and that tax piece, as opposed to sort of a bigger picture thing overall, like risk.
yeah,
And the particular one I was listening to was talking about leverage and what's a good rate of leverage and things like that. And I've changed over my life to the point that I just really encourage people now not to be carrying debt,
yeah.
for sure, other than car loans and a small amount of mortgage. Don't do that. Uh, and given me, I get concerned about the budget, the deficit levels, things like that. I don't mean to be overly pessimistic, but I'm sort of in this world of I think this is probably a good time for people to get their financial houses overall in
Yep.
order, and where they're not over leveraged, just so that they have flexibility in case things don't work out the way they expect.
I
Um,
think that's an excellent point.
and so you know, I don't know. I'm really curious to see how. I know this isn't directly answering your question, but I'm really curious to see sort of what growth we do get in terms of tax revenues off this legislation. Because that was one of the things that's been talked about a lot politically. Is there's if you do the static thing where you don't take any growth into account, it's like 5 trillion, and then if you end up with much bigger growth than is, you do dynamic scoring with a high rate of growth, it ends up not being negative. And so, it'll be interesting to see what actually comes out when we when we see what the revenues do. One thing we know for sure, right? If we have 0% tax rate, we don't collect any tax revenue, and if we have 100% tax rate, we don't collect any revenue because nobody
Yeah.
does anything.
Yeah.
And we
Yeah.
just need to kind of see where we are in terms of how much new investment, how much do we grow the tax base
I
with this stuff. And I don't know.
I think you make a great point. I mean, the key to tax planning is not necessarily even maximizing deductions even necessarily. What it is trying to maximize your after tax wealth.
Yeah.
And so I've often told clients, Bill, I've said that nobody's ever gotten mad at me as a financial advisor for ever recommending that they pay off their mortgage.
Right.
So their mortgage is yeah, it's their biggest tax deduction of that mortgage interest, but um that's not something that that people want to keep, right? I mean, debt kind of keeps you working, and debt is the thing that kind of keeps you kind of going. And so so yeah, I think that's well said. We still do have a lot of uncertainty. I think that is kind of part of
Yeah.
this as well.
Yeah, I agree. I mean, we're probably got certainty on rates, certainty on deductions, like standard deductions and things like that for another 4 years. Beyond that, again, we'll see what happens with the budget. But there comes a point where increased deficits become unsustainable, and
Right.
so we'll see how much growth they get, and then that'll
Yeah.
kind of determine that. One thing we haven't talked about yet that I'm really curious to see is how the states are going to react to all this stuff,
Yeah.
where they're no longer going to, because so many of these states they tie to the federal number, but they got to have balanced budgets,
Yeah. Yeah.
and North Carolina's always had kind of the crazy add back of, like the 85% of the bonus depreciation. So I'm really curious
Hmm.
to see what they have to deal with, this year. And of course, other states are the same, but that's another area where professionals are going to have to really watch is to see how the states react.
I think that's a great point as well. I mean, the world of multi-state taxation, anytime that we see a big federal bill pass through, they need to react somehow. And
Yeah,
so, so it is interesting to see kind of how those budgets are going to come together. It'll be interesting to see how interest rates, come out of all of this too. I think that we are just in a
yeah,
world of flux. Maybe the message to the practitioners are is just is be patient, and let these things develop, and maybe don't get in too big of a hurry to sort of jump on maybe some tax incentive bad spot, that may not set them up well for the future. Maybe that's kind of more the message.
yeah. No, I would agree with that. I mean, now I understand there are some things in the real estate world that seem to only make sense when you take the tax advantages of the
Yeah.
depreciation and things like that
Sure.
into account, or the leverage into account. But in general, if a thing doesn't make sense absent taxes, you probably shouldn't be doing it.
There it is.
It just, again, chasing after just a tax benefit, I don't know. I just tend to think that's not really the best thing to do. Look at the thing that makes the most overall sense. And uh, I to me, my advice to people now is just to do things that will keep you safe and comfortable. Like you said, people don't get mad when they paid off their debt a little bit early, right? That
Yeah.
doesn't
Yeah.
that doesn't throw them off a whole lot. And my philosophy is like yours. What I tell my students is, our job help people have the most after tax wealth they can in an ethical way.
There
And
you go.
that's what I tell my students. That's our job as professionals, for tax and for financial planning. And so,
Yeah.
um,
Yeah.
yeah, it's going to be an interesting few years as we move forward, I think.
I couldn't have said it any better myself, Bill. So, Bill, I just want to say thank you so much for being on here today. I always enjoy talking to you, especially about this stuff. I think it's you help me make some sense out of some of these things that are going on in the world around us, and I appreciate the perspective, and I know that a lot of our listeners appreciate the perspective as well. If folks would like to get a hold of you, how would they be able to do that?
Well, you can reach me through if it's related to education stuff. I can't use my university email for non-university stuff, but it's related to our program at UNCG. You can reach me at jwharden@uncg.edu. And if it's anything that's not university related, my practice email, it's kind of long. I'll ask Dave to post it. It's James William Harden, CPA CHFC at gmail.com. So that's kind of long. So I'll just ask you to post that up if you can in your notes, and they'll be able to get at me that way.
Absolutely. So, well, Bill, thank you so much for joining us. And everybody, thank you so much for joining us on this episode of Accountable. Thanks so much.
Thanks again, Dave.
Thanks for listening to Accountable. Be sure to subscribe for more interviews and insights from today's business leaders.